Good morning, everyone, and welcome to this month's Horizons webinar. I'm John Wilson, Head of Technical at Spence & Partners. Before turning to today's agenda, just the usual bit of quick housekeeping. The platform that we're using for the webinar today means that the only voice you will hear is mine, but engagement is, as always, encouraged. So please post any comments or questions to the Q&A box that hopefully you can see the icon for in the corner of your screen. It should be towards the upper right part of the webinar screen. Now, just checking that the transition of the slides is working, and it does appear to be. Today's agenda is really a focus on developments to be aware of in Q4 2020 and to a lesser extent slightly beyond that as well into 2020 and further afield. I should also begin by saying that I put my slide deck together prior to, I think, yesterday's announcement that the formal autumn budget will not be going ahead as it normally does in the autumn, but there will be a spending review, and I actually suspect that in light of recent government announcements and the fact that we are awaiting an announcement on details of a possible replacement for the coronavirus job replacement scheme, that some of the comments that I'm going to make on what might be in the budget when it eventually happens are perhaps more relevant than ever. So I will get on to the budget whenever that might be. Maybe the other big ticket issue at the moment is with just 3 months to go before the end of the transition period, where we'll leave the European Union proper, I want to provide a reminder of some of the possible considerations for pension scheme trustees, particularly where they have pension scheme sponsors that are trading internationally. And also in Q4, latest estimates are November, December. The outcome of the third and probably final hearing in the Lloyds Bank GMP Guaranteed Minimum Pension Equalisation case should be known, and this is some 2 years after the substantive ruling in October 2018. And then the plan is to finish with a quick roundup of other topics for trustees' risk registers. And I'll look out for questions in that Q&A box as I go through the presentation. So please feel free to chip in with comments or questions at any time. So, turning to the budget, the expectation was that this would normally happen in November, but this is not a normal year. And the suggestion now is that the budget is postponed and possibly to 2021. But also in more normal times, total government receipts in a tax year are around 800 billion, with, as you would expect, most of the tax take coming from income tax, from national insurance contributions, and from value added tax. But consequent upon the global pandemic, there is currently, and I say currently because I think it's only likely to get bigger, a 130 billion black hole. That is a budget forecast of around 800 billion and a latest forecast of around 670 billion. Now, on top of that, central government spending so far in 2021 is 36% higher than a year ago, 2019-20, and net debt has risen by 20.4% of gross domestic product on the previous year. So in cash terms, net debt has hit 2 trillion for, as I understand it, the first time ever. And this leads me to the relevance of the budget to occupational pension schemes, because it is being increasingly speculated that pensions being viewed as a bit of a soft target to help get us out of this black hole. We are likely to see some proposals around changes to pensions tax relief. And in fact, speculation that pensions tax relief reform is being considered is probably as tense as I have seen it in recent years. And when you consider that the cost of tax relief is currently about £40 billion per annum, and that's before you take into account national insurance relief on pension contributions, abolition of higher and additional rate relief could make a material difference to government receipts. And another reason for believing that the government may be serious about reform this time, apart from the fact that many taxpayers do not understand the current marginal rate relief system that we have in the UK, is that most of the pensions tax relief, as shown on this slide, goes to higher earners. So part of the rationale for any reform would undoubtedly include arguments around fairness and equity. How change would though apply to the growing number of schemes where member contributions are made by salary sacrifice and therefore technically paid by scheme employers? I'm not sure, apart from the fact that new salary sacrifice schemes could be abolished. I do think that there is sufficient evidence to expect something on the budget on private pensions, and it may not be the news that many pension savers want to hear. So perhaps something to keep in mind for those contemplating additional contributions to their workplace pension schemes. Moving on and turning to Brexit, it is now, believe it or not, nearly 3 years since the then Prime Minister, Theresa May, invoked Article 50, thereby signalling the formal end to our near 50-year membership of the European Union. Now, Brexit has probably been on your pension scheme register for at least those 3 years, but from the start of 2021, with it increasingly looking like we're leaving the European Union without any deal, it begins to get a little bit serious. So we need to start thinking about what pension schemes should be doing. And my thoughts in terms of priorities for pension schemes is that these should include payment of benefits. And obviously I'm talking about payment of benefits beyond UK borders. Now, fortunately, the Department for Work and Pensions guidance makes clear that the government does not expect the payment of pensions from a pension scheme to overseas members to change in 2021, whatever the outcome of negotiations. Also, in practice and in our experience as a pension scheme administrator, trustees typically insist on paying a pension into a UK bank account where a member lives overseas, although some schemes do permit payment to an overseas bank account. All that said, trustees will though want to check with scheme administrators that nothing will interrupt the payment of benefits to members living overseas in the European Economic Area on or after the 1st of January 2021. Data protection, the General Data Protection Regulations and Data Protection Act 2018. If the data privacy laws in the UK are considered adequate by the European Union, then after 2021, this would allow the continued flow of personal data to and from the UK. But if this isn't the case, pension schemes will need to consider what other mechanisms they can use for the flow of data. So the considerations for the flow of data between the UK and EU member states will be like the flow of data from the UK and countries outside of the European Union. Now turning to your integrated risk management and covenant investment and funding. In this regard, I think it's worth having another look at the pensions regulator guidance. Prepare your defined benefit pension scheme for a future European Union relationship. A bit like COVID-19, Brexit will have an impact on many sponsors. On investment, the message is that pension schemes should probably not be swayed by short-term movements in markets. And the guidance from the pensions regulator covers not just defined benefit, but also DC schemes, where the focus is also on investments, on member communications, and on administration. The key message, or overarching message, is, I think quite rightly, careful communications, especially around members who are approaching retirement. So, enough on Brexit for now, and moving on again to something completely different. Guaranteed minimum pension, or GMP equalisation, or perhaps more accurately addressing inequalities that arise from GMPs that are in your pension schemes as a result of being contracted out prior to 1997, is another topic that just seems to have been around for a long time. But nevertheless, few schemes in our experience, and speaking to other consultancies as well, outside of those involved in buying out pension scheme liabilities, have still not done anything about GMP equalisation. So as we approach the 2-year anniversary of the substantive Lloyds Bank GMP equalisation ruling 2018, this probably is a situation that cannot go on for much longer. Or to put it another way, maybe the question that Trustee Bowers should be asking is, how long is it acceptable for pension scheme trustees to knowingly and deliberately pay members the wrong benefits? Taking into account the fact that we're not expecting much in the way of further guidance from HMRC, most but not all of the industry guidance for pension schemes has been published now, and the Lloyds Bank, who are at the centre of all this, if you like, are starting to take steps to equalise GMPs in their own schemes. They have more than one, and they're using, for those familiar with the different options available for GMP equalisation, method B, which can cost a bit more in some ways, but they have decided to go down method B as opposed to method C2 or to conversion, because they have decided that that is administratively simple for the size of pension schemes that they operate. And also for those putting off their projects on the premise that the amounts involved are so small, very recent research, actually just published in the last few days, indicates that pension scheme members could now be waiting to receive up to 25,000 in GMP equalisation back payments. The research by XPS estimates that between 1.25 million and 1.5 million pensioners could be owed money following the 2018 Lloyds judgment. So not such a small amount after all. Now this brings me to my final substantive slide, which is a bit of a roundup of other things going on now or becoming law around the end of 2020. So continuing with the reference to COVID-19, the pensions regulator has updated its COVID-19 guidance on reporting duties and enforcement activity. This specifies that from 1st January 2021, defined contribution schemes will resume the reporting of late contribution payments no later than 90 days after the due date, reduced from the maximum time frame of 150 days that was set at the start of the pandemic in March 2020. It's worth adding that we have had 3 iterations of pensions regulator guidance since the beginning of the global pandemic. There was guidance that was issued in March, which was effective to June. Then we have the guidance which is currently in force but will soon expire, and there is guidance which is beginning in October. And it's maybe worth adding that, you know, just depending on what announcements we see from the government over the coming days and weeks, it seems likely that we will see further iterations of COVID-19 guidance from the pensions regulator. But the next iteration, which is, as I said, effective from 1 October 2020, will see other types of enforcement return to normal. So the processes and procedures being as per the pensions regulator operations pre the original COVID-19 guidance. And this includes the enforcement of the requirement for schemes to submit audited accounts and investment statement reviews. Guidance for trustees considering employer requests for a reduction or suspension of deficit recovery contributions in DB schemes is not changing for now, but according to the pensions regulator, it does remain under review to be updated in line with the evolving situation. Our own experience is that we are actually seeing perhaps a growing number of requests from pension scheme sponsors for some suspension of deficit recovery contributions and sometimes ongoing contributions as well. So that area of pensions regulator guidance remains very, very relevant. Moving on from the pensions regulator to the Pension Protection Fund, and on a more positive note, the Pension Protection Fund has stated that its latest modelling shows that they are well placed to achieve their self-sufficiency target, and more importantly, that its 2020-21 levy estimate remains unchanged from its announcement last year. It also continues to regard any decision to cut member benefits, which it can do, as a matter for the most extreme scenarios only. And this is not something that it currently foresees. But that said, as the end of the furlough scheme approaches, depending on any replacement, further business failures seem inevitable. And going by the impact of the 2008 credit crunch, a spike in PPF cases seems likely. If you look back at the financial crisis of 2008-2009, there was really beginning about 2010, 2011, quite a large jump in the number of schemes transferring to the Pension Protection Fund. Maybe that is the only analogy that we have to go on just now, but it does seem likely that we will see a spike in PPF cases again, maybe not until 2021, 2022, and maybe years after that. But the forecast has to be inevitably that a knock-on effect on the Pension Protection Fund levy will follow. Getting to more immediate considerations, hopefully all trustees are familiar with the updates that need to be made to their statement of investment principles and the additional information that needs to be included in annual reports starting from 1st of October. That is annual reports which are signed after the 1st of October 2020. The information being a statement around compliance with the SIP and a bit of detail around trustees' policies in areas on ESG, that is the environment, social and governance issue. Now, it's important to note that the content and the timing is a little different as between DB and DC schemes, but we are now beginning to see the new disclosures being reflected in member communications and in financial reports. And I think our expectation over time is that, as we saw with chair statements, which have been around since 2015, the pensions regulator will eventually make more use of its enforcement powers against schemes that are not observing the letter and spirit of the new requirements. So just to sum that up, hopefully in the first year of operation of the new requirements coming into force in October, a bit of a light touch approach, and it will suffice if not all information is available to say so and to say what steps are being taken to obtain it. But going forward, when we're all a little bit more familiar with the prescribed requirements, perhaps a slightly more rigid stance towards enforcement from the pensions regulator, who, as with Chair's statements, is responsible for overseeing compliance. Now, finally on this slide, the Pensions Minister, Guy Opperman, recently stated that he expects the latest pension scheme bill to have royal assent by the end of this year. Now, if that is the case, then we expect consultation on the underlying regulations to start possibly as early as the first quarter of 2021. Now, consultation on the attendant regulations will cover the new scheme funding rules for defined benefit pension schemes, increased powers for the pensions regulator, which could affect the nature and timing of corporate transactions, collective defined contribution schemes, another type of pension scheme, of which Guy Opperman still believes that there is interest in, beyond Royal Mail, which has already stated that it will be setting one up. Information for the new pensions dashboard, where people will eventually be able to have a one-stop shop to look at their pension rights across different occupational pension schemes and the state scheme. And one to watch out for as well, possible restrictions on member cash equivalent transfer rights to help curb the growing proliferation of pension scams. A proposed amendment has been made to the pension scheme bill, which is essentially to the effect that where a member otherwise has a statutory right to a transfer, but there is a suspicion that a pension scam may be involved in terms of the receiving scheme or the underlying investments, then that statutory right will become a discretion for the trustees of the transferring scheme, who would then need to look at all the evidence and decide whether or not to allow, using their discretion, for the member to transfer out the pension benefits. And I mentioned already in the environment, social and governance, there is also further provision taking the existing measures further in terms of disclosures that trustees need to make around climate change. And in fact, there is a live consultation on the detail of these new disclosures going on at the moment. So I think suffice to say that this is another area that's quite fluid, and the expectation is that pension schemes will have more and more measures imposed on them in this area as we move forward. So all in all, 2020 is looking to be another busy year for trustees, but I think it's probably quite correct to say that has any other year been any different? I'm just going to do a quick check now of Q&As. We do still have a few times. We usually try to make these webinars last around 30 minutes. So any questions on any of the areas, there is still time to post them. But I suppose kind of summing up in terms of possible actions to take away on the budget, although we don't know when that will be, there really does seem to be a growing view that there might be something there on pensions tax relief. So something to bear in mind in terms of maybe using up any tax relief which is left for this tax year. On Brexit, dust down the measures in the risk register that you probably already have in that area, because it does start to get serious from the turn of the year. On GMP Equalisation, look out for industry guidance on some of the more knotty tax issues, and look out for the third hearing in the Lloyds Bank Group Equalisation case, which is now expected November, December. I believe that the judge in that case has asked for another hearing of the parties involved, which is one of the reasons for the delay. But increasingly, it is looking like where there have been transfers out and the transferring scheme paid a transfer which was not equalised for GMPs, then liability for topping up will, at least in part, rest with that transferring scheme, which throws up a whole raft of issues, not least what do you do if you still don't have the records for transfers that may have been paid out 20 or more years ago. Some of the other measures there, the COVID-19 guidance from the pensions regulator is on their website. There's a dedicated site now on the website on this, and I think, you know, all I can say there is that we're moving on to the third iteration of the guidance. I suspect it will not be the last, especially if we see new job retention measures being introduced to replace the current coronavirus job retention scheme. The investment disclosures, we're only days away now until these measures come into place. So remember, SIPs to be updated, defined benefit and defined contribution, additional information to be included in annual reports impacting particularly DC schemes, and new requirements where they don't already exist for information to be available publicly and free of charge on a website. And another Act of Parliament on pension schemes. We are averaging at the moment a new statute on pension schemes every 3 years since the Pension Schemes Act 1993, which was a consolidating act back in the 1990s. This is an important one, particularly for defined benefit pension schemes, depending on where we go with the new statutory funding regime and the new code of practice, which the regulator is consulting on. We are looking at the possibility of, in practice, just more money going into more pension schemes more quickly at a time where you know, money is going to be more tight than ever. There remain concerns in the industry over the new powers of the pensions regulator and the impact that they could have on what were ostensibly legitimate transactions. We will see if there's any take up for alternative pension schemes designs like CDC. Transfer rights, probably a good measure if it reduces pension scams, and yet more and more disclosures in the area of responsible investment. And actually, as part of the changes to the defined benefit funding regime, we are going to see what is in effect an equivalent to the DC chair statement for defined benefit pension schemes. So it will be interesting to see what measures that chairs of DB pension schemes are being asked to report on and sign off as part of their annual report and accounts. And as we approach 10 o'clock, I'm just doing a last check of the Q&A box and not seeing anything being posted. So we will finish on time then. Hopefully see everyone at the next Horizons webinar. And in the meantime, please stay safe, have a good time, have a good day, and I will speak to you next time. Thank you and goodbye.